Did you know 10 CEOs you've never met are currently holding your entire net worth hostage? For 35 years, I've made millions using one safe strategy, the S&P 500. It gave me 10% returns year after year, but I'm here to tell you that old playbook has officially become a suicide note. If you're holding a standard index fund, you aren't investing, you're gambling. For every single dollar you put in, 40 cents goes straight into just 10 tech giants. They are banking on a $2 trillion AI miracle that the math simply does not support. The game has changed, and playing it safe is now your biggest structural risk. In this video, I'm revealing the 5 moves I'm making to protect my wealth and put you in the top 1% who see the crash before it hits. What city are you watching from, and what is the number 1 financial risk keeping you up at night? Let's talk in the comments. The illusion of safety is the most expensive product on Wall Street. For decades, the S&P 500 has been the golden standard, returning an average of 10% annually. It was the ultimate set-and-forget tool for the average investor. By buying the index, you were buying a slice of 500 different businesses. If the retail sector slumped, technology carried the weight. If energy dipped, healthcare provided the floor. This was the law of large numbers, but that law has been repealed. Currently, for every single dollar you deploy into the S&P 500, 40 cents is instantly concentrated into just 10 companies. We are talking about Microsoft, Apple, Nvidia, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and JP Morgan. This is no longer a diversified index. It is a concentrated tech fund masquerading as a broad market safety net. The mechanism behind this is the market cap weighted structure. In this system, the more expensive a company becomes, the more of your money it is forced to take. It is a self-fulfilling prophecy of the highest order. As these 10 titans grow, passive index funds are legally obligated to buy more of them, pushing the price even higher, which in turn forces even more buying. Now look at the catalyst. Except for Berkshire and JP Morgan, every name on that list is currently engaged in a desperate high-stakes arms race. They are burning billions on artificial intelligence. To justify their current stock prices, these companies must generate an additional $2 trillion in revenue. To understand the absurdity of that figure, consider this. That is more than the combined 2024 revenue of Nvidia, Apple, Microsoft, Amazon, and Meta. We are not valuing these companies based on their balance sheets. We are valuing them based on a miracle. The debt being used to fuel this growth is often obscured. We see leaders like Sam Altman discussing $1.4 trillion in infrastructure spending while OpenAI generates a mere fraction of that in actual revenue. This is a feedback loop where companies pass money to one another to inflate valuations, creating an appearance of strength that Deutsche Bank suggests is the only thing keeping the United States out of a technical recession. The first law of elite investing is to recognize when a structural advantage has turned into a structural liability. Many suggest the solution is the equal-weighted index. On paper, it is a perfect countermove. Instead of 40% of your money sitting in 10 stocks, each of the 500 companies gets a flat 0.2% share. You are protected from the AI bubble because your exposure is capped. However, the elite understand a deeper truth. The equal-weighted index suffers from negative momentum. In the world of high finance, we call this selling your winners to fund your losers. Every time a company like Tesla or Nvidia has a breakout year, the fund is forced to sell those shares to buy more of the companies that are underperforming. You are essentially punishing success to maintain an arbitrary balance. Furthermore, the constant rebalancing creates a high turnover rate, leading to hidden transaction costs that erode your compounding over time. This is why I am not abandoning the S&P 500 entirely, but I am aggressively reducing my weight. My capital is moving toward a global perspective. There is a dangerous form of American exceptionalism in the world of finance. We have had a 14-year run of absolute dominance, which has led to a cognitive bias where investors believe the U.S. will remain the center of the financial universe forever. History suggests otherwise. Imagine it is the year 1900. The United Kingdom is the undisputed global superpower. London is the heartbeat of world trade. The British Empire controls 24% of the global stock market. To an investor in 1900, suggesting that the UK would lose its dominance would have sounded like insanity. Yet the 20th century had other plans. Fast forward to the late 1980s, Japan was the future. Their automotive and electronics sectors were decapping American industry. Tokyo's real estate was so inflated that the grounds of the Imperial Palace were worth more than the entire state of California. People truly believed Japan would own the 21st century. They were wrong. The point is that economic leadership is not a permanent state, it is a revolving door. By tethering 100% of your wealth to the S&P 500, you are intentionally blinding yourself to global giants like TSMC, Samsung, Toyota, and AstraZeneca. These are not secondary players. These are the engines of the global economy, and they are currently being ignored because of their zip codes. To hedge against this, I am utilizing global funds like the Vanguard FTSE All World, known by the ticker VWRP. This fund allows me to hold nearly 4,000 companies across 45 countries. It is a self-correcting organism. If the U.S. dominance fades and the East rises, the fund automatically rebalances to where the growth is. It charges a negligible fee of 0.19%. For the cost of a cup of coffee, you can own the entire world. Do you believe the United States can maintain its total market dominance for another 20 years? Or are we witnessing the inevitable sunset of an empire? Comment below with either dominance or rotation. I want to see who is paying attention to the macro cycles. Now let us discuss the second shift, the overlooked zone. In the current market, there are 4 distinct quadrants. First, the crowded zone. This is where the retail herd lives. It is Nvidia, Tesla, and Meta. The valuations are astronomical and the expectations are even higher. It is a room where everyone is trying to exit through the same small door at once. Second, the defensive zone. These are the cash cows, McDonald's, Coca-Cola, Walmart. They are the safe harbors in a storm, but they rarely offer the explosive growth needed for true financial freedom. Third, the speculative zone. This is the playground of gamblers, Peloton, Beyond Meat, the meme stocks. These are companies with no path to profitability, fueled entirely by internet hype and dopamine. Avoid this zone if you value your sleep. Finally, we have the overlooked zone. This is where the 1% are currently moving their chips. The giants in the crowded zone are all betting that they will own the definitive AI model, but the reality of technology is that models are becoming a commodity. When everyone has access to a superintelligent model, the value is no longer in who built the model, but in who uses it most efficiently. Think of it as the difference between a blacksmith and a duelist. The blacksmith spends years and millions of dollars forging the perfect sword. But if everyone can eventually buy a similar sword for a fraction of the price, the blacksmith's profit margins collapse. The person who wins is the duelist who knows how to use the sword to claim territory. I am shifting my focus to small and mid-cap companies that are not trying to build the next ChatGPT. Instead, they are integrating existing AI models to slash their operating costs by 60 or 70%. These companies are lean, they are profitable, and they are not carrying the billions of dollars in infrastructure debt that the tech giants are. They are the underdogs who will benefit from the AI price war without having to fight in it. If you are a founder of a company in this sector, I am actively looking to deploy capital. But for the individual investor, looking into mid-cap ETFs is the most actionable way to capture this rotation. The third major shift is the return to hard assets. Every technological leap in history has been accompanied by a period of profound instability. AI is not just a tool for productivity, it is a tool that challenges the very concept of trust. In a world where AI can forge a voice, a face, and a digital signature, the value of anything digital begins to erode. This is why central banks are currently on a gold-buying spree not seen since the mid-90s. China has been aggressively accumulating gold, moving away from U.S. treasuries. They are building what is known as the Gold Corridor, facilitating trade with the BRICS nations using gold as the ultimate layer of trust. But the real news that the mainstream media missed was the Basel III reclassification. As of 2025, gold has been upgraded to a Tier 1 asset. In simple terms, for the first time in modern history, commercial banks can count physical gold as a zero-risk asset, exactly like cash or U.S. government bonds. Before this, gold was penalized on a bank's balance sheet. Now the handcuffs are off. Bank of America has already updated its guidance, suggesting that institutional reserves of gold should move from 20% to 30%. That 10% shift represents trillions of dollars in new demand for an asset that cannot be printed, programmed, or faked by an AI. I am not a doomsday prepper. I am a realist. I hold physical gold as insurance, and I use gold ETFs for liquidity. I am not betting that the world will end. I am betting that the world will eventually remember the value of things that actually exist in the physical realm. When you look at the screen and see your portfolio numbers, you are looking at digital promises. Gold is the only financial asset that is not someone else's liability. Does the rise of digital fakes and AI deepfakes make you more or less likely to trust the traditional banking system? Share your thoughts below. This is a safe space for the truth. Finally, the most underrated weapon in an elite portfolio, the luxury of liquidity. The biggest mistake the average investor makes is being 100% invested at all times. They fear missing out on a few percentage points of growth, so they leave themselves with zero margin for error. When life happens, or when the market corrects, they are forced to liquidate their positions at the bottom to pay their bills. Look at Warren Buffett. As of early 2025, Berkshire Hathaway is sitting on nearly $350 billion in cash and short-term equivalents. Does Buffett hate making money? Of course not. He is a value investor who understands that in an overvalued market, cash is not trash. Cash is a call option on every other asset class. Having a massive cash reserve allows you to move with predatory speed when the panic hits. I am currently increasing my cash position to ensure that if the AI bubble pops, I am not the one crying on social media. I am the one buying the fire sale. I survived the dot-com crash and the 2008 financial crisis because I understood one thing. The market is a pendulum. It always swings too far in one direction, and it always eventually swings back. The goal is to be the person standing at the bottom of the arc with a bucket, not the person clinging to the pendulum as it hits the ceiling. This is why I am also focusing on high-income skills. In a crash, your ability to generate new cash flow is more valuable than your existing portfolio. If you have the skills to make $10,000 a month regardless of what the S&P 500 is doing, you have achieved true freedom. True wealth is not a number on a screen. It is the ability to walk through a world of chaos with a sense of total calm. The average person is currently walking into a trap, driven by the fear of being left behind by the AI revolution. They are piling into the same 10 stocks at the same high prices, hoping for a miracle that the math simply does not support. As for those of you still watching, the ones who have stayed until the very end, I want to give you one final truth that most financial advisors are too afraid to tell you. The greatest threat to your wealth is not a market crash. It is the tax of inactivity. Most people will watch this video, feel a momentary sense of urgency, and then do absolutely nothing. They will go back to their passive index funds and hope for the best. The elite do not hope, they prepare. The bonus insight is this. The real winners of the AI era will not be the companies that build the smartest machines. They will be the humans who retain the rarest qualities, judgment, physical sovereignty, and the courage to move against the herd. Diversification is not just about assets. It is about diversifying your reliance away from a single system. If you have understood the weight of what has been discussed here today, I want you to comment the secret password, I am awake. This is how we identify the builders and the visionaries in our community. If this analysis provided you with real value, do the community a favor, like this video and share it with one person who is currently overleveraged in tech. Subscribing to channel is not just a click, it is a commitment to a higher standard of financial intelligence. We do not beg for engagement. We facilitate the exchange of elite knowledge. Now do not stop here. Your education is just beginning. Click on the next video appearing on your screen to understand the specific mechanics of the global rotation we discussed today. The system is changing. Make sure you are the one holding the map. I will see you in the next one.